For decades, the traditional path to financial stability was clear. Secure a stable job, buy a suburban home with a 30-year mortgage, and put your money into a standard retirement account. But today, following that exact blueprint is a guaranteed trap that keeps the middle class running on a financial treadmill. The macroeconomic landscape has shifted. Inflation, stubborn interest rates, and the rising costs of basic commodities mean that traditional saving habits are actually eroding your purchasing power every single day. If you want to break out of this cycle, you must stop investing like the average person. The top 1% of wealth builders don't lock up their entire net worth in a liquid, heavily leveraged physical assets. Instead, they focus heavily on cash flow optimization, asymmetric risk rewards, and high-yielding liquidity. In this video, we are unpacking the exact structural shifts happening right now, why the standard savings model is failing, and how you can position your personal portfolio to thrive in this new environment. We will analyze the real math behind opportunity costs and show you how to redirect your capital into high-velocity compounding accounts. Stop playing by old rules that were designed for a different economic era. If you are ready to protect your wealth and take control of your financial destiny, hit that like button for the algorithm, subscribe to this channel for premium macro insights, and comment below, what is your primary investment vehicle right now? That was the promise. Stable job. Stable house. Stable savings. But stability only works when the numbers cooperate. And right now, the numbers are working against the average household. If inflation is running near 3.8%, and your savings account is paying around 0.4%, you are not standing still. You are falling behind in slow motion. Quietly. Relentlessly. That is the hidden tax on caution. Every month you hold cash that earns less than inflation, your money buys a little less than it did before. And that tax matters more now, because money itself has a price again. The Federal Reserve has held the federal funds rate in the 3.5 to 3.75% range. That sounds abstract until it shows up in your life. On credit cards. On auto loans. On business financing. On mortgages. The old middle-class playbook was built in a world where leverage was cheap, where borrowing felt almost frictionless. In this era, leverage is priced like a luxury. That shift changes everything. It changes the way families buy homes. It changes the way investors evaluate risk. It changes the way cash should be treated. Because when the cost of capital rises, bad capital allocation becomes more expensive than ever. A dollar sitting in the wrong place is not just idle. It is losing to inflation, losing to opportunity cost, and losing to time. And here is the part most people miss. The middle class is not just dealing with higher prices. It is also dealing with thinner breathing room. The personal saving rate has been around 3.6%. Real average hourly earnings have slipped. That means wages are not fully absorbing the higher cost of life. So households feel richer on paper, but poorer in reality. The paycheck arrives. The bills clear. And there is very little margin left to make smart moves. That is the treadmill. When your cushion is thin, any shock forces you into the most expensive form of financing. Panic. A car repair. A medical bill. A job loss. A family emergency. Suddenly, the balance is not coming from surplus capital. It is coming from debt. And debt in a high-rate environment is unforgiving. This is why liquidity is becoming a first-class asset category again. Look at what people are doing with their money. Cash-like instruments are attracting enormous capital because, for the first time in years, parking money is no longer pointless. Money market funds have swelled to about $7.8 trillion. That is not just a trend. It is a message. People want optionality. They want yield without giving up access. They want capital they can move when opportunity appears. Because liquidity is not laziness. Liquidity is freedom. It gives you the ability to wait for the right moment instead of being forced into the wrong one. It gives you flexibility when markets shift, when rates change, when your personal life changes. It turns money into a tool, not a hostage. That is the modern wealth-building difference. The old model said, lock it up and wait. Buy the house. Max out the retirement account. Hope the market cooperates. But the new model asks a better question. Where can each dollar do the most work, the fastest with the least waste? That is opportunity cost thinking. If your cash earns 0.4% and inflation is 3.8%, the gap is not theoretical. It is real. It compounds against you every year. $1,000 held the wrong way does not just sit there. It slowly transforms into less future purchasing power. $10,000. $50,000. The same math. Bigger consequences. So the goal is not to avoid saving. The goal is to deploy capital intentionally. You want some money reserved for liquidity. You want some money working for cash flow. And you want some money reserved for long-term compounding. Those are different jobs. They should not all be forced into the same bucket. A retirement account can still be powerful, but it is slow money. It is designed for long horizons, tax advantages, and disciplined compounding. It is not designed to help you navigate near-term shocks. And for many households, retirement wealth is locked behind age rules, penalties, and market timing risk. The same is true with housing. Homeownership can absolutely be a powerful inflation hedge. A fixed-rate mortgage can be a gift if you locked it in when money was cheap. It can act like a forced savings machine. But the danger is concentration. The Federal Reserve's own household balance sheet data has made this plain. The middle of the net worth distribution is dominated by housing. For a huge share of families, the biggest asset is also the biggest obligation. And that is where fragility enters the picture. Because if most of your wealth lives in one illiquid asset, you are exposed to job shocks, refinancing shocks, local market shocks, and life shocks all at once. Your house can be a strong asset. It can also be your most expensive form of illiquidity. That is why capital velocity matters so much now. Capital velocity means your money keeps moving through productive cycles. It earns, it redeploys, it compounds again. The more quickly and efficiently capital can be recycled into new opportunities, the more at-bats you get. And more at-bats mean more chances for compounding to work in your favor. This is why high-quality liquidity has become so valuable. Not because cash is exciting. Because cash with yield creates options. Short-duration instruments, high-quality cash equivalents, and other liquid vehicles can serve as staging grounds. They keep your capital accessible while still producing some return. That is a very different mindset from simply parking money and hoping for the best. And then there is asymmetry. Asymmetric risk-reward means you are looking for positions where the downside is controlled, but the upside remains meaningful. You do not need every dollar to hit a home run. You need a portfolio that can survive, adapt, and then compound when the right opportunities appear. That is how wealthy people think in changing regimes. They do not just ask what something might earn. They ask what it costs to wait, what it costs to be wrong, and what it costs to be locked in. Even direct stock ownership tells the story. More families own stocks now than a few years ago, but many hold relatively small slices. That is not a criticism. It is a sign that people are trying to participate, but often without enough capital structure around them. Owning an asset is not the same as owning a strategy. And that is the point. You do not need to abandon every traditional tool. You need to rethink the order of operations. Liquidity first. Cash flow second. Compounding third. That order gives you resilience. It gives you range. It gives you the ability to say yes when the right opportunity shows up, instead of being trapped by the last one you took. So ask yourself a hard question. Is your money positioned for the economy that existed 20 years ago, or the one that exists right now? Because the old rules were built for cheap money, rising purchasing power, and a smoother path to wealth. This era is different. Money has a price. Inflation has teeth. And capital placement matters more than ever. If you want to protect your wealth in this environment, stop thinking only about how much you earn. Start thinking about how long your money can survive, how quickly it can move, and how hard it can compound once it gets there. Run your real return audit today. Like, subscribe, and comment your primary investment vehicle.